It is now really my distinct pleasure to introduce the legendary Larry Robbins. So Larry, I'm just making sure Larry's here. Yes? Okay, great. So Larry is, Anthony Scaramucci still gives me PTSD from last year. So Larry Robbins is the founder and CEO of Glenview Capital Management, a $6.6 billion investment management firm in its 19th year of operation. Over its 18 plus years, Larry has managed to almost double the returns of the S&P 500, focusing on deep fundamental research and individual security selection. Headquartered in New York, Glenview has 75 employees, including 34 investment professionals. And prior to founding Glenview, Larry was an analyst and partner at Omega. He was at Gloucher and Company doing mergers and acquisitions. He is a graduate of the Wharton School and the Moore School of University of Pennsylvania, where he received multiple degrees in economics and engineering. And since those two weren't enough, Larry also became a certified public accountant and a heart surgeon, and no, that's not in here. Philanthropically, through their Robbins Family Foundation, Larry and his wife, Sarah May, are active supporters of education reform, both in New York City and on the national level. Larry serves as the chairman of the board of the Robin Hood Foundation in KIPP, New York. He's a member of the board of Relay Graduate School of Education, Learn and Teach for America. And in addition, he's the chair of the Wall Street division at the UJ Federation. And if you thought his life could not get any busier, this is wild. Larry is also the proud coach of several New Jersey Avalanche youth hockey teams and resides in New Jersey with his wife, with New York with his wife and 6 sons. And he coaches all of them in hockey. Incredible. The fireside chat will be, with Larry, will be moderated by my partner and dear friend, Jeremy Rosmarin. Ladies and gentlemen, please welcome to the stage, Larry Robbins and Jeremy Rosmarin.
First of all, I really appreciate that warm introduction. I'm sorry to disappoint you. The legendary Larry Robbins isn't here. You just get me. So I don't know if there's a legendary one. But
I'm not sure I buy that for a second.
You got the average version. So.
Well, the average version will be fantastic. Actually, we have a lot to cover, so I do want to dive right in, and I do definitely want to talk about specific names in the portfolio
sure.
and the strategy that's going on in the portfolio. But before we do that, I do want to talk to you a little bit about Glenview in general. And you started the firm, founded it, still the sole PM, when you were 30, been a long time. Seen a lot of, not that long.
No, it's been a long time. I turned 50 last month. They hit me kind of hard, so, but I appreciate you bringing that up. Anyway.
You're welcome. And, well, it's been long enough that you've seen a lot of other firms close it down, like sure. A lot of them are shutting down. So I'm wondering, what's keeping you going at this point? And how do you stay motivated, all these employees around?
Sure. Well, first of all, thank you for having me, and on behalf of Glenview, thank you for having us be able to speak with you today. The needs of our clients are perpetual. Many of the clients that we manage money for, they are pension funds that have what seems like perpetual obligations to their employees. We manage money for charities who want to take the capital that has been so generously donated, they want to compound it. We manage money for families who want to not only keep up with the cost of living, but to be able to do other things for themselves and the family members that they represent. And so while the capital markets have been very, very friendly to investors over the last 20 years, as interest rates have come down, as multiples have expanded, as people look forward, they're asking themselves a very hard question, which is how do we make acceptable, if not double-digit returns for the next 10 years and the 10 years after that. And we at Glenview owe all of our success to our early clients who had the confidence in us day one, to trust, as you mentioned, a 30-year-old portfolio manager with their capital. And because their needs go on well beyond the financial needs of ourselves as individuals, we are fully committed in order to try to sprint for them each and every year. I do hope to do a 30-year career at Glenview. I do hope that in year 31, which will be another 11 years from now, that there will be younger, fresher legs that I can pass the baton to, and that they can take the intellectual capital of Glenview and perpetuate that beyond there. But right now, we're pretty much engaged in the fight of what we can do with our current portfolio and how we can build value over the near and medium term for the clients we have.
Right, and as you kind of look to what that next generation might look like. And, you coach your son's hockey, and
it will not be them. sorry, 6 sons to disappoint you, but it will not be those 6.
I'm wondering, having that experience on the coaching side, not only with family, but also all these other people who you're trying to bring them up, mentor them in other types of ways, does that translate at all into maybe not the PM side, the investing side, but the executive side with 75 employees, and how you try and have a good work environment?
Sure. So you did mention, I was my first managerial job was as the CEO of Glenview. It's a wonderful industry. People can trust you with their capital, and they can trust you with their careers to join you. Of course, knowing that you've never managed people before, et cetera, but you've managed capital and managed a portfolio. So as they said in the introduction, I'm a CPA and an engineer by training, so I can put you to sleep in a variety of different ways. But as far as managing people, that was something that I had to learn on the job. And whether it be from the social and philanthropic organizations that I've been lucky enough to be a part of, or whether it's be through coaching youth, I've had to pick up those managerial and really training skills kind of on the job from other areas and import them into Glenview. So the stocks that we own today, the situations that we find interesting today, the companies we're using on the short side to hedge today are different than those that existed 5 years ago or 10 years ago or 15 years ago. But the approach and the philosophy and the training and the human capital dynamics, et cetera, are reasonably persistent. One thing I found was that it was hard for me to give valuable, honest feedback to people who were either my senior or who had reached a level of stature in the world. And so I didn't as aggressively give feedback to my employees and my partners early on in my career, and yet I found myself being able to hold a 13-year-old accountable for when they don't back check and don't move the puck. I have no problem benching them. And then all of a sudden it occurs to you, it's like, wait a minute, this is a child, right? You have an easier time holding a child accountable for a simple task. We should certainly be able to hold our peers and our partners, in fact, even our company managements and boards, accountable for doing their job in a fair way and an equitable way. But it certainly was empowering, using those coaching experiences or taking things from the culture of high-performing charter schools and trying to import that into the management culture and leadership culture that we have at Glenview. Glenview is named Glenview because I started playing hockey at age 5 in Glenview, Illinois, a suburb of Chicago. And I thought when I started the firm that the lessons I learned in youth sports would be at least as valuable as the lessons I learned in college and in my early jobs on the technical side. And I can say after 19 years of running Glenview that it is more than 50% the ethos that you get from competing in team sports and team athletics, right, or any kind of team activity that really brings a group of people together for a common purpose like we're doing at Glenview.
Yeah, we actually have at least a few professional athletes, one of whom will be speaking later on today. And there's been an interesting cross-section of either whether it's professional athletes, collegiate athletes, because in the U.S., such a rich NCAA system, people well educated and transferring those skills over.
Sure. Well, I was very fortunate to have limited athletic abilities, so it was not a hard job. It was not a hard job for me to figure out which route to take. So that's somewhat self-selected.
So let's talk about the investing side.
Sure.
Specifically healthcare.
Mm-hmm.
Biggest sector allocation for Glenview for the last 15 years. I believe, correct me if I'm wrong, it's around 60% of the long book right now.
That is correct.
So what's happening in the space in terms of why you, either historically and also on a go-forward basis, assuming that's still the case, see it as so attractive?
Sure. So number one is we are a valuation-sensitive firm, and we look for a good or great business at a good or great price. That sounds like a lot of common sense, and yet if you think about the investing environment for the last 5 years, the best thing you could have done is find a good or great business at any price. Valuation actually hasn't had any real seat at the table, either as a risk mitigant or as a return accelerator. But nonetheless, we don't believe that fundamental investing has been repealed or replaced in the US or around the world. We simply think that it's been somewhat ignored, but ultimately over time and over cycles, we believe valuation matters. I have no idea. The plane was landing today. We were coming through fog. We couldn't see a thing. And I joked around with my partner, Bob Burns, who's here, that was the economic outlook for the next 6 quarters. You couldn't see a thing. It was very, very cloudy. Nobody knew what was really below. And yet, and I could really say that at almost any time. If you go 4 or 6 quarters out, I think all of us are humble enough to know that there's too many events in the world, macroeconomic, political, that we can't really call or forecast the economy now in the U.S. We have, trade wars and tariffs to deal with, as well as another uncontrollable variable. Why do we invest in healthcare in the U.S.? Because through the end of the next decade, 65-year-olds are growing at 3% per year, whereas overall U.S. population is growing at 70 basis points per year. And my car breaks down after 8 or 9 years, and human bodies break down after age 65, and they require more hospitalization. And 85-year-olds are growing at 3% a year through 2050. So why do people rob banks? That's where the money is. Why do we invest in healthcare? That's where the growth is. I am much more confident on the demographic table saying that 1 year from now we will all get 1 year older than I am saying that 1 year from now U.S. GDP will accelerate or decelerate by 50 or 100 basis points. The real answer on those things is who knows. Now, the other thing that's always hung over U.S. healthcare policy and U.S. healthcare equities is, are we really happy in the U.S. with our system that sees us spend 17% of GDP on healthcare overall, that sees U.S. healthcare costs well above average, not only in pharmaceuticals where we pay 3 times that which the rest of the world pays for the same exact pill and the same exact drug, but also in other aspects of healthcare we seem to be more expensive. And so for that reason, valuations have been exceedingly low, not only in the last year or two, but really for the preponderance of the last 15 years, as the market tries to grapple with how is the U.S. going to fix this issue and what's really going to happen. And I can give you a 20-year history of U.S. healthcare policy in about 30 seconds. Only 2 things have happened in the last 20 years. Number 1, we passed Medicare Part D in 2003, went into effect in 2006, and we said to our seniors, if you're 65 right now, we pay for your doctor, we pay for your lab test, we pay for your diagnosis, we send you to Walgreens or CVS, we don't pay for your prescriptions, love America, right? Pretty dumb way to do it. And so under a Republican administration, with a Republican House and a Republican Senate and a Republican White House, they passed the Medicare Part D Act, and now seniors, with a little bit of a donut hole and copay, have drug coverage. And in 2010, we said, you know what, we have 310 million or 315 million people in the U.S., but 54 of them don't have insurance. And many people have underinsurance. If you have a pre-existing condition, good luck getting insurance. And so under a Democratic administration with a Democratic president, a Democratic House, and a Democratic Senate, we passed the Affordable Care Act, also known as Obamacare. And about 18 million of those 54 million people who didn't have health care now have health care. Right? And both of those things were good for pharmaceutical companies, and they were good for pharmaceutical benefit managers, and they were good for drug distributors, and they were good for hospitals, and they were good for labs, because they were more inclusive and people had more money to pay for healthcare. And those are the only 2 things that have ever happened in U.S. healthcare. And the third thing that's going to happen probably in the next administration is that the U.S.'s trade policy is going to stop paying 3 times as much for the same exact drug. And other than that, right, we can all talk and debate till we're blue in the face, nothing else is going to happen in healthcare. And that's allowed us to invest in wonderful companies with recurring free cash flow, with uninterrupted growth, companies who've grew double digits in 2008 and 2009, despite the fact that the S&P 500's earnings went backwards by 20%. And the fact that we can cut through the noise, do our work, and own the companies with confidence has allowed us to generate not only significant value retrospectively, but as we look at our portfolio, our overall portfolio is trading at just under 12 times earnings. Next year's earnings, when the market is 17, is trading at 10.5 times 2021 earnings. And the market in 9 months will turn the calendar and turn its sights towards 2021. And so we're able to invest with a valuation and margin of safety. We're able to invest in uninterrupted growth. We're able to invest in stable growth and stable cash flows, all with low valuations in a place that, frankly, we can't find any place else in any other sector.
Great. So there's a lot in there I want to unpack, and at least 2 kind of additional things on the healthcare side. But first of all, no, it's. I mean, the one piece that people often talk about, and I think that you hear it a lot, is okay. Well, that's all well and good, but there's a huge amount of these unknown unknowns. For example, Medicare for all, or Democratic candidates campaigning on all these ideas. So the first question is, how do you even handicap something which, at least from the perspective of people who might not be aware of the system, or maybe they think might be catastrophic for those types of businesses? And second of all, what are the actual things that need to happen logistically in the government for that to even be a reality?
So I love the fact that you use the word, how do you handicap? My father was an accountant by training and worked at a horse race track called Arlington Park Racetrack outside of Chicago. And so I was going to racetracks since I was 5 years old. So handicapping is something that's near and dear to my heart. And if you're trying to figure out what the odds that a horse wins a race, there's a lot of things that can happen that are unanticipated in order for the horse to go 7 furlongs or a mile and a quarter or whatever it's running, et cetera, to get to the finish line. Let's think about how we handicap Medicare for All's trip around the track. Right? Number one, a candidate that supports Medicare for All has to win the U.S. presidential election. Right? The Democratic Party is split. The moderates don't like it. The progressive left candidates, right? Elizabeth Warren, Bernie Sanders, they like it. So let's say it's 50-50 that Trump wins, even though some people would shudder at that idea, et cetera, but it's probably 50-50 with a healthy economy going into election that Trump retains his seat. Right? And within there, it's probably 50-50 that you get a progressive versus a moderate in the Democratic Party. So right now you got 25% chance of that happening. But in the Senate, and in order to pass a bill, you need to get through the Senate in order to get Medicare for All. Right now there's 53 Republican senators, and Alabama, for the one time in the last, 50 years, has a Democratic senator because of a scandal, but that's likely to flip Republican. You're basically going into the election pro forma 54-46, and you need to get to at least 50-50, or else this is all just an academic exercise, right? And then even further, right, you can only pass something with 50 votes and the vice president in the event that it's budget neutral, and that's what they did with the Affordable Care Act. How is the Affordable Care Act budget neutral? It took in taxes for 10 years, it spent money for 7 years, and it said, look, it's neutral, even though they spent 1.5 times what they took in, because they just did it for less years. Well, if you wanted to do that with Medicare for All is going to cost $32 to $34 trillion, right? The cost of the Affordable Care Act was $1.4 trillion. So you have something that's literally 20 times more expensive. You're going to have to get 60 votes. You can't do it through reconciliation because of the Byrd rule, which is a technicality. Right? Then you look at the fact that of the 47 sitting senators that are there, 16 of them are on record saying that they oppose Medicare for All. Right? So in order for it to happen, in order for this horse to get around the track, as we handicap the odds, right, you start getting narrower and narrower and narrower and narrower. And then you look at, well, what would Medicare for All really mean? And Elizabeth Warren, the leading candidate among the progressives, on November 1st, a week ago Friday, came out with her plan. And she said, unlike the words, I'm with Bernie, which was her whole health care plan up until then, she now said, Bernie said if they do Medicare for All, that the U.S. government would pay no more and probably less to the providers, including hospitals. And Elizabeth Warren came out November 1st and said, if we do Medicare for All, we will pay hospitals 10% more. And for teaching in rural hospitals, we'll pay them even more than that because we know that they will lose profits from their commercial payers, and we need to have a healthy, vibrant hospital industry so that people can get quality care in the U.S. And because of that, what we know is when we put that into our models, you know what happens to HCA, the largest hospital in the U.S.? They earn more under Medicare for All than they currently do. And that's not even pro forma for the fact that you'd have the other 40 million people be able to walk in, and if they have a car accident, a heart attack, or a triage situation, that somebody can actually pay their bills or not. Now, we ourselves are not betting now that Medicare for All happens just because it's good for our HCA investment or our tenant investment, but that's the funnel that we go through. And so the hardest thing for us to ask ourselves is, what discount will the market put on do I want to own an equity that I could have to deal with headline noise and headline risk over the next 3 months or 3 quarters or 3 years? And that's a very difficult question, and frankly one which we struggled with. Our fund had volatility in April when Medicare for All seemed to put the HMOs in the penalty box. We had a drawdown in August when Elizabeth Warren rose in the polls. And yet our fund's done quite well this year, and our healthcare equities have done quite well this year. I can't tell you when other people are going to worry about the noise. What we can say is that what ultimately drives economics for businesses is the recurring cash they generate, the certainty of it, the allocation of that capital, and on those fronts, we again conclude that the odds of Medicare for All are quite low. The odds that we have Medicare for more or insurance for more are quite high. To date, the only 2 things in the last 20 years that have offered more, not less, insurance coverage, one on pharma and one on overall health insurance, have both been positive for for-profit companies, and we believe the next wave also will be.
Right. So I think I might know the answer to this, but if you had to choose between, and you do choose often, between companies, one which is, has no uncertainty or very little uncertainty, fantastic company, but you have to buy it at 30 times revenue or some very, very high valuation, compared to another company which is fundamentally strong, mired in uncertainty, and you can buy it at a relatively inexpensive price, for your view of what its value is. You view the latter one as actually being less risky. I think
Sure. Look, I think all of us would understand that if we buy $1 of earnings for 2 times those earnings, that it's less risky than buying it at 20 times earnings or 200 times, because at some point in time, the sum of the cash flows gives you back your whole investment. So let's take the aforementioned HCA, which is our largest hospital investment. HCA was LBO'd not once but twice. KKR took it private again in 2007 and took it public again in the second quarter of 2011. They took it public at $24 a share. It was $30, but they paid $2 special dividends right away, so $24 was the net cost to people who've held it. Right? Today the stock is at $135. It's been a 5.5 times multiple. Right? When the stock went from 30 to 18, or from 24 to 12 net the dividends, it only took actually 4 months, because there was another hospital scare and healthcare scare in the third quarter of 2011. People didn't like levered equities, and we convinced the company to repurchase 16% of their stock in that quarter. So they bought 16% of the company at $12 a share. Right? Next year, HCA is going to earn $12 a share. Right? They paid 1 times year 8 earnings. Right? So here's the question. Do we like companies that have the financial flexibility that in the event that the multiple continues to compress, that they could retire more and more of the equity, and therefore that we as owners can own a greater and greater percentage of the business? The answer is yes. And if you look at the earnings growth of HCA, if you simply bought and held that stock over 8 years, you made 21.5% for just making one decision: buy it at the IPO. Right? Obviously, the company did better with its repurchase because it was at a discount to that. And that was really generated by 16.5% earnings growth and about 4% multiple expansion per year. And now HCA trades all the way up to 11 times earnings, and it's still cheap. It's just not 8 times earnings. But we absolutely prefer investing in the lower end of the valuation spectrum, providing that, number one, earnings are real and they're cash. And number two is that management and the board will use the cash wisely, including if the company puts if the market puts the company's own shares on sale at a discount, that rather than going out and buying somebody else's company or buying some different business or buying something at 30 times revenues because it's new and shiny and different, as long as they allocate their capital to its highest and best use, then we love situations like that.
I want to get back to the HCA example, but,
Sure.
but before doing that, just in terms of how you engage them and everything, but before that, you talked before pricing and costs in the U.S. system. Price per capita much higher. Some question on whether the results are better. Right? There's different metrics that people use. So I guess the first part of that is, how does that cost leave the system? And then from an investment standpoint, are there any short opportunities? So benefiting from a company stock price going down, are there any opportunities that might arise from that cost being flushed out?
Sure. So we don't have enough time for me to try to give you Glenview's view from the corner of the world about what's wrong with the U.S. healthcare system. We would simply say that things that have been tried and true, that have both bent the cost curve downwards and improved the quality curve, it starts with scale. Right? So there used to be 10 drug distributors, people who took pills from the 500 different manufacturers to the drugstores, whether they be independent chains or the large Walgreens and CVS. And the people who do the transportation, it's not UPS and it's not FedEx, because you need separate custody of the pills, pick, pack, and ship facilities, et cetera. So there used to be 10 or 11, and now there's 3. And 10 years from now, there will be 3, and 10 years after that, there will be 3, because the antitrust authorities won't let them consolidate anymore, but nobody's going to be able to get into that business. And the reason is that it's a scale business with high throughput and low margins, and once you get to that efficiency, that's one way to bend the cost curve down. There used to be 10 or 12 pharmaceutical benefit managers, people who would get together, a bunch of people, and say, Pfizer and Merck, we know you have different statins, and we know that you have lots of science behind it, but let's be honest, A statin's a statin, and for 80% of the people, we could take a Pfizer product or a Merck product, and it's the same darn thing. Whoever gives us the lowest price wins, and by the way, then if one PBM merges with another PBM and they represent twice as many lives, they go back to Pfizer and Merck and say, hey, now we're twice as big, how about you give us an even better deal? And so pharmaceutical inflation in the 90s used to be 12%. And in the 2000s, it was 2%. And believe it or not, despite the headlines, pharmaceutical inflation in the US at the counter is negative. Pharma prices are actually going down at the counter for US consumers. Now, they're going down from a very, very high level. It's like saying Manhattan real estate prices have gotten a little bit soft, right? Like, it's still ridiculous. It's just slightly less ridiculous than it used to be. So those are the ways in which to bend the cost curve down, and we continue to invest in those things. Moving care into lower cost settings, into the home, into surgical centers, away from higher cost centers, that's another way to do it. Yes, hospitals we continue to love. There's been 1% less volume on average per year in hospitals than there per year over the last 14 years. But what's happening is that most of that volume is coming out of the small, regional, independent hospitals, whereas the big national chains and the big urban centers, where all the science is, where the complicated procedures are, they're taking share, and so they're benefiting from that consolidation and scale business. So those are the things that are driving that cost and quality curve. There also will be technologies, but unlike popular opinion, technology will not replace the large payers, the managed care players. It's not going to be some startup in a garage or Google or Apple that replaces Cigna and that replaces Anthem and that replaces United Healthcare. Those companies will be adopters of the technology that comes out of garages, that comes out of Silicon Valley, that allows people to use better wellness care, better wellness monitoring. That too will help us bend the cost curve down. Finally, in the U.S., we spend a lot of time in the last 2 weeks of life, last 4 weeks of life. It's a social issue that's not worth debating, but we do spend a lot of time in end-of-life care, and a lot of money. And as a society, I think we've, in the U.S., decided that that's fair and appropriate, and I'm not sure that that's going to change.
Right. It sounds like on the healthcare side, there will be winners and there will also be losers. It's not just everything.
And you mentioned on the, what is there in short? Coming into the year, we had a very large short position in pharmaceutical companies. We were short 16 different pharmaceutical companies because, as I mentioned, we do believe that whether it be through executive order that does not need Congress to do it, that the U.S. can pay less for the drugs that it buys through executive order, or there will be a congressional bill. There will be one passed in the House next month, but I don't think the House, the Senate, and Trump can agree on anything. But the next administration might be able to. And so while we are long two significant special situations, Takeda and Bausch and pharma, we've been net short pharma the whole year. It's been a pretty big underperformer and a contributor to a lot of alpha we've generated this year on the short side. And so between that, there's some medical device companies that charge too much in the U.S. that we think will get arbitraged away. So yes, there's a steady stream of individual companies that are over-earning. But we find that you got to look for them hard, and you got to be very specific about when that bubble will burst. Otherwise, you get run over.
I do want to talk also about active and picking, whether that's because there's so much trend now happening towards passive. So people even saying, forget winners, forget losers. Mm-hmm. I will have either a whole sector allocation or just buy the broad market index.
Sure.
But maybe actually before we talk about that and some of the opportunities or risks it might create, let's go back to HCA.
Sure.
And maybe some other examples. How is what you do in that type of situation similar to or different than pure activism, completely passive? Like, how are you trying to close the gap between where you see value and things that in your perception are being oversold?
Sure. So number one is we're a longer term organization. Our average holding period is about 4.5 or 5 years. There's been a dozen companies we've owned 10 years or longer. So when we say that we think and act like owners, we do that in every way possible. We are what we call suggestivists. We know that we only own a minority of the company. We know that our primary role is to make suggestions to the board, to the CEO, to the CFO, and that those suggestions we simply think should get fair weighting, and they should get fair balance vis-a-vis all the other suggestions that are internally generated by the companies and externally generated by our fellow shareholders. We don't have an exclusivity on good ideas. We don't have to get our way all the time, but we do want to make sure that the company is thinking clearly about the issues that drive stakeholder value for their customers, because ultimately if you don't have customers, you don't have a business, for their people, so it's a sustainable business, and ultimately also for its owners. We've only done 2 activist campaigns in 19 years. We fully threw out the board of a hospital company called HMA because they were horrifically run. The company was sold at an 85% premium through that process. And we put 2 people on the board of Tenet Healthcare. We actually had to step off the board to get rid of our standstill to then get change. When we stepped off the board, they finally replaced the CEO, and the earnings have tripled and the stock has doubled, and we're starting to get some traction there. So, but in general, we would much rather partner with the companies rather than be adversaries as a traditional activist would. There's a company called Meritor which makes truck axles for Class 8 trucks. There's nothing to do with healthcare. There are some things we do that have nothing to do with healthcare. Right? There's no Amazon risk in trucking. In fact, Amazon uses more trucks than many other people. Delivery's going more local. 10 years from now, we're still going to need Class 8 trucks. Class 8 trucks are going to still need an axle. These guys have 70% market share. They're going to have 70% market share in the next 10 years. Right? It's a cyclical business. Economy does well, they'll make more trucks. Economy doesn't, they'll make less trucks. But there's a replacement demand, so you don't have a down cycle that lasts 3 to 4 years. If you have 1 year where you underproduce, the trucks age, the cost to maintain them goes up, and therefore it refreshes itself. We just filed a 13D 6 weeks ago. We just filed a 13G yesterday, which means we were active, quote unquote, engaged for all of 6 weeks, is what we call flash activism. We did that, we went restricted, we gave the company a bunch of different suggestions. The company was in violent agreement with most of them. They had thought of a couple of them on their own. We happened to think of the same things at the same time. We had slightly different take on it. They announced earnings a couple days ago. The stock's up 50% in the last 6 weeks. They came out and they said that on what was $1 billion for equity 6 weeks ago, that they are selling a business that we wanted them to sell. That between free cash flow, the proceeds from that business, they're going to buy back $700 million of stock, or half the company as of measured 6 weeks ago, over the next 2 years in a methodical way. And at our encouragement, they laid out what would happen in a downside recession. Here's what our earnings would be. Here's where our leverage would be. To say, yeah, we're prepared for it. We know we're a cyclical business. But despite that, our earnings are going to go from $2.80 to $4 despite the cycle. And there's going to be a lot of capital deployment and that's a much better, more effective way. And by the way, the fact that we've owned Meritor for 11 years allows us to have a little bit more credibility than if we just show up and say, hi, we're a big bad hedge fund from New York, and we've been shareholders for 4 seconds, and here's the things we want you to do to create 3 minutes of value so that we can then go out and move on. And it's just a different approach. There's a Canadian company, Bausch Health, that used to be Valiant. Valiant had a long and storied history of buying everything, running up their stock price, and then have everything that they bought turn out not so good. The last 3 years has been new management at Bausch Health. Bausch Health has done everything right in the last 3 years under new management. They sold some businesses, paid down debt, all their debt trades above par. They invested in 7 different franchises that they call their Significant 7 that'll create new medications over the next 5 years. They think each of them has $1 billion revenue potential. They're doing what's right for patients. They're doing what's right for their employees. They paid them during this time. They did what's right for bondholders. They secured the liquidity of the company. The stock price is down 23% since they got there because it went from 5 times earnings to 5 times earnings, and earnings per share have gone down because they sold some things and they were dilutive, and what Valiant bought as Valiant wasn't so Valiant, right? Having said that, right, what could they do now? Well, now if we look forward 2 years to June of 21, 75% of their earnings come from 2 phenomenal businesses, each of which is saleable. They should sell at least one of them. They should take that capital. They should buy back stock, just like Meritor is doing. If you sell something for 15 times EBITDA and you turn around and you buy stock at 5 times earnings, it turns out that that's a pretty good deal. And what you own is the remainder of a company that's even cheaper. In fact, we think the sum of the parts value of Bausch is $72. The stock is $27, right? Up from $19 8 weeks ago. Right? So how are we going to be effective with Bausch? We're going to be effective because we want to work with management and the board. We don't necessarily need to dictate the timing of these strategies. We're not going to set a fuse and say, by this date certain, you must do that, otherwise we're going to be the big bad wolf and blow the house down. Because they're in the business of saving lives, they're in the business of hiring researchers. There's a lot of reasons why one wants to partner with the board and management in getting the right outcome. But make no mistake about it, we will find a way to get the right outcome there, because there's too much money that we can capture for our clients that we can take that capital and we can repurpose it in other things, and so we'll be dogged in that. So that whole spectrum is the process of suggestivism. Sometimes we're invited in by the companies, sometimes we're knocking on the door. Occasionally, twice we had to kick down the door. We prefer not doing that, but most of the time we want to think and act like owners. You mentioned passive investing. Vanguard had a great idea, which was 45 years ago. John Bogle said, people are expense, and let's get rid of expense, let's get rid of people. Let's simplify the investing business to be one phone call. Are you in the S&P 500 still this year? Yes, thank you, that's it, right? Look, no expenses. What's the problem? You know the last asset that nobody did any work on? U.S. mortgages, right? Some genius said, hey, look, let's take a $200,000 loan, let's cut it up into slices, let's take a $6,000 slice and call it a triple B slice. Let's take 1,000 of those things and put them in $6 of value at a time into a grocery bag. And if you wanted to take a taxi to verify that the house actually existed, you spent more in cab fare than the value of your $6 loan. And everybody decided, don't worry about it because we're going to make one phone call to S&P and Moody's. Are these things still triple B? Yes, thank you. Right? And what happened? Everybody lost all their money in triple B mortgages. They went to zero. Right? We were short them, we know. Right? That's what happens when you do entirely passive investing. I don't know any person I've ever met who says that they want to have no information, no transparency, no insight at all in what their largest investments are doing. Right? On the contrary, we write 20-page letters. We are open books with our investors. We want to share with them our thoughts. We're not always right, but when we make mistakes, we want to explain what the mistakes were and what we're doing about them. Right? I know that I want that transparency in my business life. I know our investors do in theirs. Passive investing goes completely against that and says, we only care about whether you're in some group or index, and we're going to assume it works out for itself. I think that that's the most dangerous type of investing. Yes, John Vogel's right, there's lower expenses. Over time, there's going to be a massive bill to pay, and there's going to be nobody there to answer the phone or explain what happens when something that only got bid up because it was in an index and things go wrong. What's going to happen? And we haven't seen that because we haven't seen tight monetary conditions in quite some time. But when we do, we think it's going to be a very, very big valuation cushion, and real companies that have real valuations and real active managers are going to do much, much better than the passive community.
We've got a few minutes left. I want to make sure we talk about some of the other stuff on the personal side, like your philanthropic work, but I'm assuming we could talk about the passive and active forever. It's somewhere between 1% and 99% should be in passive. It sounds like you wouldn't say there should be zero of it. It has a role, but if it has too much, then there's nobody doing market research. There's nobody who's doing price discovery. Capital allocation breaks down. So I think that has to be true, right? I mean, at a certain point, if passive was everything, there would be no capital market function.
Let's just think about how private equity has made so much money over the last 30 years. And there's been a bunch of leading Canadian institutions who've turned to the private equity markets and said, you know what? We want to invest our capital through the private equity markets, which means we want to pay a 40% premium to buy something. We want to take a 15% discount to get out of our liquidity. How are they doing it? Well, we can say, well, gee, they're levering it, so they're making it up that way. But what's the real value and magic sauce of private equity? That they get to actively control the board and think and act like owners in a way that's focused on economics and not focused on a popularity contest to be in the Toronto Stock Exchange Index or the S&P 500 Index, et cetera, et cetera. That's how they've gotten their value. Our question is simple. Why can't we do that as minority investors in plurality in the public markets without paying a premium on the way in, without getting a discount on the way out, without taking on excess leverage? Why can't we do that as a community of investors? And one company at a time, one situation at a time, we're trying to move companies from the undervalued, overlooked camp into the traditional camp. We owned First Data, the largest payment processor in the United States. Another KKR LBO. We bought it in 2016. We bought it at 7.9 times earnings. Over the 3 years we owned it, they grew revenue at 5, they grew EBITDA at 7, they grew earnings at 14, right? Very Glenview waterfall type business. But everybody knows that there was a private equity overhang because KKR owned it. And it wasn't in the S&P 500 because there was AB voting shares. And Square is new and First Data is old. So we got to go buy the new thing at gazillion times earnings. And we can't own the old thing, even though that's actually what's processing the transactions. And then in January, First Data got bought by Fiserv. And your buy and hold returns between the time we bought it and the time that transaction closed were 34% annualized. So you got paid to actually own an equity that actually had real characteristics. But here's the catch. Now Fiserv trades at 22 times earnings per share, and half the earnings come from First Data. And First Data is an independent public company, only traded between 8 and 11 times per share. Right? Why is it that the same exact package, when you change the wrapper, is valued twice as much at the grocery store? Because it has an S&P 500 brand on it versus when it doesn't. Right? I can argue till we're blue in the face about why that is, but you can say it differently. How do we get the things, how can we buy things cheaply at the discount market, and how can we go out and sell them at twice the value?
Right.
And that's the business that we're trying to be in, which is saying, hey, look, I don't necessarily need to argue with it. I'm fine with a vibrant passive community. How can I get my companies to both, how can I own as much as possible through capital allocation, and then turn around and flip them to people who have passive equity valuations, and we'll be quite happy with that transition.
Right. And before we wrap up, I on the philanthropic side, so Larry, for those of you who don't know, very involved in a whole bunch of different causes in a big way, whether it's educational reform and healthcare, and in addition to obviously being in the financial markets for so long. And I wonder if you might talk to a little bit, what really motivates you on the philanthropic side, and maybe some of the opportunities in a couple of minutes.
Sure. So, and you and I were talking in the past. So I have 6 children. They were all born at Mount Sinai Hospital on 5th Avenue at 98th Street in New York City. So it's a pretty Tony address. And the thing that's unique about New York is that there's so many communities that all live intertwined. And so if you go a mile and a half north of Mount Sinai, you're in Harlem. There are communities that are a mile and a half north, they're in abject poverty. And if you go a mile and a half south, you go to the Upper East Side of Manhattan, where kids have first, second, third, fourth chances to have a great life. They have everything basically provided for them. And so all my children walked out of that hospital at 2 days old, and we walked out, and lucky for my kids, they turned left, and they went south. But about half of Mount Sinai's babies that are born are Medicaid or Medicare reimbursed, and they're going up to Harlem, and they're going up to the Bronx, and they're going north. And why should an African-American male born in Harlem have a 3% chance of graduating college, and a white male who's going to go to the Upper East Side has a 70% chance of graduating college and a 100% chance they're going to get a 5th, 6th, and 7th opportunity? And we can say all we want about the decisions that people make in life and the value of hard work, and I believe in the value of hard work, and I believe that there should be consequences, and I don't believe that we should have a socialistic society, et cetera. But I've never met one person who explained to me why that 2-day-old should have any different opportunity, whether they turn left or right. So I feel obviously extremely fortunate. My grandparents came over to the country. They worked very hard. I got provided a great education. I went to public schools. I happened to have some great school teachers who lit a spark and lit a fire under me. I feel extremely fortunate for the industry in which I work in. But yeah, I do feel a sense of responsibility that if New York's a big community, and yeah, there's 1.8 million New Yorkers living in poverty, right? A third of which are children. None of us should be able to sleep well at night unless they have the same exact opportunity to use education to elevate themselves. And so I'm super proud of the fact that KIPP Charter Schools has built a $110 million high school at 144th and Park that's now the second best high school in the state as measured by U.S. News and World Report. That's not the second best low-income neighborhood high school, et cetera, right? That's versus Scarsdale, New York, versus Stuyvesant, versus everything. It's the second best high school there, and it was built because of the energy of some entrepreneurs and a belief that every child can succeed. And KIPP students now go on to college and graduate college above the national average. They've totally flipped that 3% stat on their head. And the only thing that's frustrating is that we can't do it even faster. We can't do it in even more neighborhoods. But it's been a pleasure for me to not only be able to support these causes, but to be able to learn from the phenomenal entrepreneurs there. And so what keeps me at the table for the next 10 years? My ability to support them will keep me at the table for the next 10 years.
Yeah, so much to talk about. First of all, are you able to stick around for a while, or do you have to go back to New York?
I'm yours for the day.
Amazing. Okay. Well, Larry, thank you so much for joining me on stage today. Really appreciate your insights, and we'll see you around.
A round of applause. Thank you. Larry, that was fantastic. Jeremy, thank you. Guys, thank you very much for, first of all, Larry, for those insights and flying up to Toronto to be with us. We have a small gift. It's a small token of our appreciation. And a donation has been given to Sick Kids in your honor.
Thank you so much.
Thank you again for joining us. One more round of applause, gentlemen.